I personally enjoy spending a portion of my cash balance in my portfolios into higher yielding assets. And this is because, of course, if a stock or ETF offers a higher than average starting yield, you're going to be receiving a lot more cash flow a lot quicker, at least supposedly. Now, some of these higher yielding ETFs are things like QYLD, things like JEPI, or even JEPQ. And although higher yielding names are awesome because of the cash flow they promise to offer, you also have to be very aware of dividend traps, something like TSLY, which as we've seen over time has paid a substantial dividend but has decayed like crazy. But in this video, we're going to go through 3 different ultra high yielding dividend paying ETFs that have a track record of paying consistent dividends over time without decaying like crazy. So if you would consider yourself a cash flow, income focused investor, definitely stick around, drop a like down below, and let's get right into the first one. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the first ultra high yielding dividend ETF that I'm absolutely obsessed with as of recently, I've been buying a ton of, is ticker symbol SPYI, or the NEOS S&P 500 High Income ETF. Now, this ETF hasn't been around all that long, but it is growing in popularity quite quickly. And for good reason, because the fund has a very unique strategy that, in my opinion, offers pretty much all the good things that more income focused cover call style ETFs can offer, but without some of the bad parts. Now, it says right here on the NEOS website, the fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. It then says actively managed by NEOS, the fund seeks to take advantage of tax loss harvesting opportunities, in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now, lastly, number 3, the fund utilizes a call option strategy that may include both selling and purchasing SPX index options, which may provide the opportunity for upside in rising equity markets. Now, that right there is massive, because a lot of these covered call income style ETFs, of course, generate a ton of income on a monthly basis normally because of the cover call overlay. But with that cover call overlay, if you understand options, you know that it sort of caps the upside. But by SPYI sometimes buying SPX options, it means there could be some massive upside potential. Now, SPYI has not been around all that long, keep in mind. We're talking August 2022, but at least since then, this ETF has not been decaying like crazy. And the max time for the ETF is down 1.2%, and this is due to the most recent sell-off, so this ETF actually hasn't grown at all as far as ETF price. But keep in mind the dividends have been massive, so this is definitely not a yield trap, at least not as of yet. Now, as far as SPYI's expense ratio, this is also something very important, especially with these covered call income focused style ETFs, because the expense ratios can get pricey sometimes. The expense ratio for SPYI is 0.68%, so it is going to cost you a bit of a pretty penny to hold on to this one, but at least so far to me, it seems like it's worth it. And this is because, as of right now, SPYI has a trailing 12-month dividend yield of 12.21%, and over time, at least historically so far, this ETF has been paying around 45 to 50 cents consistently, month after month to investors, which is significant, especially for an ETF that costs around $50 per share. But I know you're probably still wondering, what is the total return for SPYI and how much has this ETF actually made or lost investors long term? And the answer to this is that if you bought SPYI on the start date of the ETF's inception and held it until now, you would have around a 9.48% annual total return if you were to reinvest dividends, of course, or an 8.6% annual average total return if you spent the dividends along the way. Either way, the fund is returning around 9 or 10% on a yearly basis as of right now, which is not bad whatsoever for those dividend income focused investors that want cash flow today. The next ultra high yielding ETF that is not a dividend trap, at least not as of yet, is SVOL, or the Simplified Volatility Premium ETF. Now, this ETF has found a spot in my portfolio for around a year or so now. And although all these super high yielding ETFs are always going to make up a small portion of my portfolio, SVOL has been pretty decent so far. Now, SVOL seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10 the inverse of the performance of the CBOE Volatility Index, or the VIX Short-Term Future Index, while also seeking to mitigate extreme volatility. More facts about SVOL, the gross expense ratio is massive. So listen closely here, we're talking 1.16% gross expense ratio, which honestly is one of the highest ETF expense ratios I've seen across the markets. But trust me, it could be worth it with SVOL's over 16% trailing 12-month yield, which we're going to talk about here in a second. Now, SVOL is down 1.26% on the 1-year time frame, and on the max time frame, it is down 15.07%. But hold on just 1 second. I promised you I was not going to show you any ultra high yielding ETFs that were going to decay and decay and decay. And although SVOL is negative on the max time frame, I promise you the total return is positive. And basically, ever since late 2022, the ETF has basically traded sideways. So we have to give it a little bit of credit here and allow it to make it through. And even though the negative long-term price performance, SVOL has paid around 32 to 30 cents every single month consistently, and this is for an ETF that costs around $20. An SVOL investment back in 2021, up until today, would have returned an average total return of around 9.24%, or around 7.54% without. Now, I'm not saying that a 9.24% average total return is the best that you're going to find across the market, but it is decent for those investors that are seeking income and seeking it today. Now, the last ultra high yielding ETF that is definitely not a yield trap is one of my favorites, one of my largest holdings, ticker symbol JEPQ, or the JPMorgan Nasdaq Equity Premium Income ETF. Now, even though I'm sure some of you guys watching this are already familiar with JEPQ, for those that aren't, the JPMorgan Nasdaq Equity Premium Income ETF seeks to deliver monthly distributable income and Nasdaq 100 exposure with less volatility. The portfolio says underlying equity portfolio employs an applied data science approach to fundamental research and portfolio construction, and with this discipline option overlay implements written out of the money Nasdaq index call options that seek to distribute monthly income. Now, JEPQ has a 0.35% expense ratio, so it is on the cheaper end for the covered call ETFs, around a 10% 30-day SEC yield. And even though historically JEPQ has paid some larger dividends than maybe what we've seen as of recently, JEPQ as far as price performance has been very impressive, up around 12.8% over the year. Now, on the max time frame, JEPQ is in the green, 3.31%, so not up all that much, but it is in the green, and that's not with dividends included, of course. Like we sort of mentioned, historically, JEPQ has had some months where dividends were much larger, and this is due to things like volatility and the fact that these covered call ETFs are not going to pay the same amount every single month. But overall, if an investor was to have invested in JEPQ way back in the day and held on to it till today, we're talking around a 10.32% average annual total return, or around an 8.5% with dividends not reinvested. So either way, once again, a dividend-focused, income-focused ETF that is going to pay a ton of cash flow from day one, but is by no means considered a dividend trap. So there we have it, 3 different high-yielding ETFs that do pay a ton of cash flow, but at least as of right now, I would not consider any of them a dividend trap. But now I want to hear from you guys down below. Out of all 3 of these ETFs we went through, if you could only pick one for whatever reason, which one would it be and why? Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.